So, Eric, what's the formula for straight line depreciation? Not the correct answer. Anybody?
Cost minus salvage value over the life.
Cost minus the salvage value divided by the useful life. Or cost minus residual value divided by the useful life. If you're calculating depreciation for a year, you use the life in years. If you're calculating it for a month, you use the useful life in months. Okay? In our example, we had a truck that was going to be around for 5 years. You divide by 5. If we were calculating it every month, it would be 5 times 12. You'd divide by 60. Good? Okay. Good? Okay. So here we go. We've got a picture of an airplane, but we're only going to pay $62,000 for this airplane. We got a deal. So we've got a $62,500 airplane. We expect that 3 years from now, we're going to be able to sell it for $2,500, or scrap it, and the metal will be worth $2,500. So our cost is $62,500. Our salvage value is $2,500. Our life is the 3 years. $62,500 minus $25,000 is $60,000 divided by 3. Depreciation is $20,000 a year. Pretty straightforward, right? No? Yes. Okay. I'm being confused. All right, questions on that? This one's the simple one, really straightforward. If you look at this in a table, you've got your depreciation expense, accumulated depreciation, accumulated balance, undepreciated book value of this airplane. Again, I'm going to call it an airplane. So, when we first buy it, the undepreciated value is the $62,500, what we paid for the airplane. Year 1, our depreciation expense is $20,000. Our accumulated is 0 plus $20,000, gives us $20,000. $62,500 minus accumulated depreciation of $20,000. Our book value of the airplane is $42,500. Everybody follow me so far? Okay, year 2, we have another $20,000 in depreciation expense. Our accumulated depreciation is 40. Seems duplicative to me there. Our accumulated is 40. $62,500 minus 40 leaves us our book value of $22,500. Third year, $20,000 depreciation. Accumulated becomes 60. Our book value ends up at $2,500. By golly, that's our salvage value, or our residual value from our original calculation. So it worked out right. But it's nice to see these on a schedule like this, especially for longer lived assets, if you've got something that's 15, 20, 30 years. Okay? Questions on how that works?
I just have a question. The residual value, if you decide to keep the asset,
It just, nope, it stays there. We made an estimate when the asset was new that it would be worth this when we sold it. We don't ever change that estimate. We continue to calculate depreciation the same way the whole time. Yeah. So it will sit there on our balance sheet with a $2,500 book value until the day we sell it, or scrap it, or whatever we do. Okay? It will never change. It will stay 60 at that point. Yeah. Questions? Other questions? Okay. Units of production. This one's fun. This is the one that varies depending on how many miles you drive the truck, or how many widgets you build in the machine, or whatever it is. How many units it produces. So what we first do is we calculate the depreciation rate. So let's stick with our truck. Our cost was $20,000. Our residual value is, no, let's call it $1,000. Okay? 20,000 minus 1,000 divided by life in units. How long did we say we were going to drive the truck for? 200. 200,000 miles. So 20,000 minus 1,000 is 19. 19 divided by 200,000 is some number. Somebody with a calculator. 0.095. 0.095. So for every mile that we drive, our depreciation expense will be 0.095 cents. Good? So if in the first year we drive that truck 50,000 miles, what's 50,000 times 0.095? Our depreciation in the first year is $4,750. Now let's think hypothetically here. We drove it 50,000 miles. That's about 1/4 of the total life of the truck, right? Based on our estimate of 200,000. 1/4 of $20,000 is how much? 5,000. Are they pretty close to each other? Okay. It was a reasonable calculation. We did not make a mistake in our calculation. Okay? Good example, hopefully. Again, we did this calculation with our own numbers, but I just want to show you that the table still applies. We paid X for the asset. We depreciate Y. Our accumulated depreciation increases, and we track our book value. Good? Yes, sir.
For these depreciation methods, they seem like they're the same methodology as the inventory methods. Like that would be the weighted measurement. The other is the unit per cost.
That's an interesting analogy, yeah. Calculating average unit per cost, or unit cost per unit.
First in,
Last in, first out, first in, last out, yeah.
So it seems like they would correspond.
They are, yeah, I've never had anyone make that analogy before, but yeah, I see your point. Other questions? Okay. Accelerated depreciation. The accelerated depreciation, if you were to graph it, you tend to have higher depreciation expense in the beginning years and less in later years. Okay? So, we calculate that by taking net book value. Here's a minor difference. You take net book value times 2 divided by the useful life in years. And I know I'm going to want some board space for this one. Actually, again, the same asset that was $62,500. In year 1, what's the net book value of that asset? It's the original cost, correct? We have no depreciation. Net book value is depreciation, or cost minus accumulated depreciation. So net book value is $62,500 times 2 divided by the useful life, which was 3. Our depreciation in year 1 is $41,000. Okay, it's a lot. It's bigger than the straight line method, correct? It's about twice as much. In year 2, when we calculate the depreciation, we take the cost minus the accumulated depreciation to get net book value, and we multiply that by the same ratio, 2 divided by 3 years. Depreciation in year 2 is only $13,900. A little rounding there. It drops off dramatically. You guys see that? Okay. So, once we throw in the table, we bought it for $62,500. First year is $41,667. Accumulated depreciation $41,667. Year 2, we take the $20,833 book value times 2 divided by 3. We get 13,889. Accumulated goes up. Our net book value is then used to calculate year 3 depreciation. 4629 times 2 divided by 3. Our net book value, if we depreciate the full $4,629, is, let me say that again. We have $6,944 as net book value. We depreciate that, the expense would be $4,629. If we do that, our net book value ends up being what? $2,315. Is there a problem with that? It's below what we said our salvage value, our residual value is. So notice that in any of the calculations in this method, residual value isn't taken into account, except at the very end in that last year. And you cannot depreciate it below the residual value. So we have to do the math and figure out what this number would be to get us with an ending book value of $2,500. So we do the math and we work backwards. We force the $2,500 here and we calculate what the depreciation would have to be to get us there. And that's our depreciation expense in the last year. Okay? So you've got to, in essence, force it the last year.
So you can go through the formula to get close to the amount and then...
And then in the last year, when you drive it below your salvage value, you stop. Okay? Okay. Yes, ma'am.
Do you pick a method, a depreciation method, based on what, like you actually, like how you're actually using your assets, or is it like the inventory where you can just pick whatever you want? And do you have to pick the same method for each asset?
You can pick a different method for each asset. And the goal under GAAP is that you pick a method that reflects the actual economics of what's going on.
Okay, so it's not like inventory where like you can pick your inventory method based on absolutely nothing in terms of like how you actually do your inventory.
Yeah. So what you want to do is if you've got an asset, a piece of equipment that you're going to use a little bit in some years and a lot in other years, you want to go with some sort of units of production. If you've got a piece of equipment that's going to, you're going to get a lot of productivity out of at the beginning and less at the end, you go double declining. If it's just going to produce the same every year, year in, year out, you go straight line. You want to I can't even talk. You want to reflect the realities of what the economic situation is. So you're going to try and make your best choice based on that. Sir?
Is this a policy issue also by GAAP, do you think, as far as encouraging companies to growth because of the significant depreciation given the first year?
See, you run into that whole issue we talked about last week, I think it was. If you're the manager of the company, you've probably got some incentive bonus plan based on net income. So do I want to accelerate my depreciation to get net income down because it affects my bonus? But if I get higher depreciation up front, I pay less taxes up front, so it helps the bottom line because I'm paying less tax. You're really torn there, and you're making this management decision based on those factors. So GAAP is intended to bring you back to reality and ground you, and let's reflect what the economics of the transaction really are. Okay? Other questions? All right, we're getting close to the end here. Let's do a couple of things. Couple more things and we'll take a break. We've talked about recording the value of an asset, its original cost, depreciating over its life. There's something called an asset impairment, and you've got to kind of look at your assets every year and determine if they've been impaired. And there was a question about this earlier. If something, let's stick with our truck example. If something happens to that truck, let's say a meteorite falls out of the sky and hits it in the parking lot and smashes it. What's my truck worth? Squat. Squash, squat, bubkiss, whatever. You're right. The truck all of a sudden has lost its value. And that event has impaired the value of my asset. In the case of an impairment, I need to write that off as a loss, and I need to remove that asset from my books, both the asset value and its accumulated depreciation. Okay? Casualty is meteorite hitting it, it being in a bad car accident, it being stolen, things of that nature. All of those are casualties that cause there to be an impairment of the value of my truck. Yes, ma'am.
What about insurance?
Okay, that's a different subject that, yes, maybe insurance will pay me back for it, but that truck is gone. I'm still going to remove it. The insurance plays into calculating what my loss was, and maybe I don't have a big loss or less loss or no loss, but I still am removing the truck. Okay? Obsolescence is a different category. All right, I'm going to make up a bad example. I have a machine that builds iPhone 5s, okay? And that's all it can do. It assembles iPhone 5s, right? Everybody wants iPhone 5s. They're the new one. They're hot. That machine works day and night, 24/7, and I make as many of these as I can so I can sell as many as I can. Well, Steve Jobs comes back from the grave and comes and says, here's iPhone 6. My machine won't build the iPhone 6 because they're different parts. What's my machine worth now? It's now obsolete. No one's going to want the iPhone 5. They want the new one, right? So if my machine becomes obsolete and it's not fully depreciated, I can't really sell it. I have a loss as a result of that. Or maybe it's partially obsolete. There's a greatly reduced demand for the iPhone 5s. I can still sell a few, so I won't write it off entirely, but I've got to write its value way, way down. Okay? So that's the obsolescence factor driven by a lack of demand for it. Good? In those cases, you're going to recognize a write-down of your asset when the impairment occurs, and on you go. That's what impairment is. Questions? Impairment's a bad thing. A fire is an impairment, an earthquake's an impairment, meteorite falling out of the sky, all that good stuff. Hurricane. When you get rid of your assets, you can sell them, you can trade them in. What's retirement mean? We take them to the scrapyard. Involuntary disposal, fire accident, meteor, flood, hurricane, tornado. Okay? When we get rid of these assets, the first thing you do, let's stick with our truck. Got a $20,000 truck, $5,000 depreciation every year. That means it has a life of 4 years. At the end of year 3, halfway through year 3, we decide we're going to sell it. We need a bigger truck. Step 1, update the depreciation through the date that you sold it. Calculate the depreciation, record the appropriate depreciation expense, and then calculate your gain and loss. Now, the book, talks about recording cash received, writing off the accumulated depreciation. Those are the mechanical steps. Let me show you what I think is an easier way to understand it. And it's all based on book value. Okay? Record the cash received. What did we sell it for? $10,000. Okay? What is our book value? Book value consists of cost, which say was $20,000, and accumulated depreciation, which say was $12,000. So my book value in total is 20 minus 12 is 8. I sold it for 10, my book value is 8. What do I have? Gain of $2,000. Everybody sees how it works? Simple? Okay. That's how we're going to calculate it. It's a little easier than jumping through some of their hoops. Questions? Answers? All right. This is simple. If you get more cash than book value, you got a gain. If you get less cash than book value, you got a loss. If you get cash and book value equals the same thing, what do you have? It means somebody told the buyer what to offer for it. Somebody on the inside. It's an inside deal. Right? Because this is never going to happen in the real world. Yeah, it's an inside deal. Okay.
But it's better than losing, right? And having a loss.
Well, a loss is called a loss for a reason. Having a loss is always a bad thing.
So it's better if it's an inside job kind of thing.
I'd rather break even than have a loss. Okay. Oh, we'll just call it that and go home. No, we're not going home. Nobody leave. Did I say that?
It's too early.
Yeah. Okay. Here we go. Southwest Airlines sold $11 million an airplane for that cost. I can talk. We sold an airplane for 11 million bucks. We got paid in cash. The equipment originally cost us $30,000 and was depreciated using straight line method with zero residual value and a useful life of 25 years. Okay? How much depreciation expense do you record in its 17th year? What? Let's go back to the previous slide. Excuse me. Okay. How do we calculate straight line depreciation? Cost minus salvage divided by life. What was our cost? $30 million. What's our salvage value? 0. Divided by, what's our life? 25 years. What's 30 million divided by 25? Anyone? $1,200,000. So our depreciation every year is $1,200,000. What's the depreciation in the 17th year? $1,200,000, right? Because it's straight line depreciation. Good? Everybody see that? Okay. Okay. After updating the depreciation, the equipment book value at the end of the 17th year is what? How do we calculate that? Now, hang on. Remember, our cost is $30 million. Okay? Our accumulated depreciation is $1.2 million every year times 17 years is how much? Hang on. Okay, $20,400,000. Good? Okay. So we think it's B. They wanted book value. Okay? So cost minus accumulated depreciation gives us $9,600,000 book value. Okay? So our accumulated depreciation over 17 years was $20,400,000, leaving our book value at $9,600,000. Good? The equipment sale. What did we sell the equipment for? I've forgotten. We sold it for 11, okay? Let's calculate this real quick. Sale, $11 million. book value of $9,600,000. Do we have gain or loss? Gain of how much? So we're going to take an estimated guess that our gain is $1.4 million. Good? Okay. The journal entry that goes with this. What did we get? We got cash. So our debit to cash, because cash increases, $11 million. Accumulated depreciation is a credit balance. So we've got to make it go away. To make a credit balance go away, we have to debit it. The equipment, the original $30 million was a debit. To make it go away, we've got to credit it. And the difference is the gain. Gains are always a credit, just like revenue. And there's your entry. Is my entry in balance? Yes. Questions? Good? Okay. So where we left off last time, the end of chapter 8, a couple more things to cover. We've been talking about depreciable assets, how we're calculating depreciation, what do you do when you get rid of them. A couple other assets that we need to know about and account for. Natural resources. This is things like oil, gas, big tracts of timber, things like that, steel mine, copper mine. And in the case of these natural resources, they don't get depreciated over a fixed period of time. They get used up, and you deplete them over the how many units you expect to get. So let me use oil, for example, because that's on the screen and that's the first thing that came to mind. If you go out and you develop an oil well, and say you pay $100,000 to drill a well, and all of a sudden you've got oil coming out of the ground. I don't know how they do it, but the geologists are able to make some sort of an estimate of how much oil is down there that you're going to get. So you take, that's the number of units you're going to produce off of that well. You take the cost and divide by the number of units, and you calculate depletion based off of that per unit rate. Okay? It's very much like the units of production depreciation we did. Everybody remember that? I know, it's been a whole week, right? Okay, so let's see. Total cost of your natural resources, cost for the acquisition, say if you have to buy the land or you have to buy the rights to the minerals below the land, any exploration costs, and developing. So if developing is if you have to go in and bulldoze the top of a hill to flatten it out to build the oil well, and then build the rig and do the drilling and all that, those are your development costs. And again, we use depletion, and it's basically a units of production sort of calculation. Questions? Okay, so the actual calculation. Acquisition and development costs, this is your total cost that I was just talking about, minus any residual value. So for example, if you buy a piece of land, you spend some money doing the exploration, you spend some money drilling the well, you know that you're going to be able to sell that land when you're done, right? For some amount. You subtract that from, that's kind of like the salvage value on a straight line depreciation. Okay, cost minus salvage value, residual value, divided by the estimated number of units that you're going to get out of it. Then you get a cost per unit that you produce, and for every unit that you pump out of the ground, in this case oil, if it was coal, it'd be, for every ton of coal you pull out, multiply that by the depletion rate, and you get your depletion cost. Depletion cost flows through inventory when it's sitting in storage somewhere, and then it becomes cost of goods sold when you actually sell the product. Okay? Questions? Answers? Moving right along. Okay, another big kind of asset that we can talk about, intangible assets. We've kind of talked about these before. These are things like patents, trademarks, right? You guys see trademarks all the time. You probably just don't think of them as such. Can you name a few? Coke, Pepsi, Kraft, yes. So all these big company names where they, you see these advertisements, Taco Bell, McDonald's, all this kind of stuff. So those are trade names, and they're also intangible assets. They have value to the company. They're not something you can touch, pick up, hold, carry around, but they are something you can sell. And because you can't actually touch them, they're called an intangible. Sometimes with an intangible, you know what the life is. Patents are an intangible, and they have a definite life. When you go and apply for a patent, they give it to you for a period of time. I want to say it's 14 years, I think. Depends on what it is. Some of them are different. But if you have, let's say we somehow got enough money to go buy Coca-Cola, and we got the Coke name. And we would pay for that, right? We would pay some amount. What's the life of that? It's infinite, yeah. So there's really no life of it. If there's no life, we're not going to calculate any amortization on that. It's going to sit on our books and show a value forever. If it's a patent and we know it's only good for 14 years, you're going to take the cost of it, divide by 14 years, and calculate depreciation for that 14 years. Now, I put that in quotes because since it's an intangible, it's called amortization. That's the only real difference. Okay? Questions on that? Okay. Go. This is what we were just talking about. If it does not have a definitive life, if it's going to be around forever, you don't amortize it at all. Here's another one. Anybody ever heard the term goodwill in a business sense before? Yes? Goodwill occurs when one company buys another. And that's really the only time it pops up. As a company operates, it can create goodwill value because it does a great job for its own customers, and customers keep wanting to come back as a result. But that never shows up on their balance sheet anywhere as an asset because it's developed internally. Much like the Coca-Cola logo, there's no item on Coke's balance sheet that says, here's the value of our logo, right? They spend advertising money all the time, and since they didn't buy the logo or the trademark, it doesn't show up on their balance sheet. If they ever sold it, the next guy would do it. So goodwill is, if we were to go out and buy a company, when you buy a company, you're buying two things. You're buying their book of business, their ongoing customers, and you're buying all of their assets. So goodwill is defined as the price you paid in excess of the market value of those assets that you bought. So if you paid $100,000 for a company and it only had $70,000 worth of assets, both tangible and intangible, you paid how much in goodwill? Say it louder. Well, we paid 70 for it. How much is the goodwill? 30, exactly. Okay. Here we go. Let's just throw it up here. A little example. Company A went out and bought Company U. Here's something that you'll see. It's fairly common. They paid $2 million and assumed some liabilities, right? That means Company U owed some money to other people, and when we bought it, we're going to pay it off for them. Okay, that's value, right? The assets were appraised at $1.8 million, fair market value. So, fair market value of the assets, $1.8 million, less the debt that we're going to assume, right? That's a detriment to us. We're going to have to pay cash for that. Less $400,000. The net fair market value of all the assets we got out of this deal was $1.4 million. Everybody see how that works? Pretty straightforward? Good. We're going to pay $2 million to get $1.4 million worth of stuff. So it looks like we paid too much if you don't think it through real well. But what we're paying for is that book of business, that repetitive nature of customers always coming back, because this company has, superior product, superior customer service, something that attracts people to it, good reputation, and it's called Goodwill. So that's how we calculate $2 million paid for $1.4 million in assets. We've got $600,000 in Goodwill. Questions? Yes, sir.
So Goodwill is that commonly known as the multiplier when you buy a business, for instance? Is that-
No, sir. That's something different. You and I can talk about that during the break. Okay? All right. Other questions? All right. Let's see. Other intangible assets, copyrights, trademarks. We've talked about trademarks already, Coca-Cola. Copyrights is one we didn't mention. If you write a book, it gets copyrighted, correct? You have an exclusive right to market that for a long time. There are some other really famous trademarks that you might not think about. Can anybody think of one? Really, really famous trademark. Mickey Mouse. Think, what? Anything Disney. Mickey Mouse, Goofy, name any of the characters. They were responsible. This used to be 50 years. These copyrights used to be good for 50 years. And if you think about the timing of when Mickey was created, that started to become a problem. Disney went out and lobbied big time to get it extended. I think it's been extended again recently to 100 years. So, but think about it. What's Disney worth if all of a sudden everybody in China can knock off all the Mickey Mouse stuff and sell it all over the place, right? They make a ton of money off of the merchandise, much less, the theme parks and the movies and all the other stuff. So they want to make sure that they protected that. So the fact that you're the only one who has a right to use the likeness of, publish anything, use that character in a movie or in a book or whatever, it's got some value, and that's a copyright. Again, it's got a known useful life, though, so you're going to amortize it over the known useful life. If you bought it, if you develop it on your own, does it have value on your balance sheet? No. Okay, so you're dividing 0 by 70, and your amortization is how much? 0. Good? Okay, questions? That's my Mickey Mouse lecture. Patents we talked about. There is one caveat with patents that I didn't mention. Here the example uses 20 years. Some patents I think are good for 20, some are good for 14. I remember there being some that were only 12. But the caveat is use the life of the patent or what you estimate the useful life of the product is. So if you come up with a patent and you're going to only be able to sell these things for like 5 years, amortize it over the 5 years and be done, even though the patent's good for longer. Okay? Franchise. We've talked about this kind of because Papa John's is one of the examples in the book. You pay for that franchise and it's an intangible asset. You amortize that over the life of the franchise. Couldn't think of franchise for a second there. Right? They gave you an exclusive right to operate Papa John's in a certain geographic area for X number of years. You know how many years, you know what you paid for it, you can do the math. Good? Okay. I'm going to even skip that right now. All right. Any questions on Chapter 8? Good. We'll stop there.